Good afternoon. My name is Bryce Drake, and today I'm going to be talking about white-collar crime and prevention. The points of interest that I have chosen to highlight are white-collar crime defined, history of white-collar crime, different types of white-collar crimes, notable cases in the United States, effects of these crimes on investors, ethics in the business world, as well as government regulation and legislation. Now, what is white-collar crime? The FBI describes white-collar crime as follows. Reportedly coined in 1939, the term white-collar crime is now synonymous with a full range of frauds committed by business and government professionals. These crimes are characterized by deceit, concealment, or violation of trust and are not dependent on the application or threat of physical force or violence. The motivation behind these crimes is financial, to obtain or avoid losing money, property, or services, or to secure a personal or business advantage. Often there is a misconception with white-collar crime that it's a victimless crime because nobody got hurt, nobody got killed, nobody was mugged, raped, beaten, but this becomes disproven time and time again, and throughout this presentation I will also illustrate how it affects individuals. The history of white-collar crime. White-collar crime has been around since the beginning of civilizations, whether that be bribery, price-fixing, or monopolies. Rise of monopolies and greater corruption came to light in the United States and much of the West during the Industrial Revolution. Corporations gained great power and the ability to make consumers pay outrageous prices, thus creating public outrage. Also, due to lack of information, securities fraud was easily committed by simply saying your company was building vast railroads in other countries, making it easy to hide investment funds and create losses. Without the flow of information such as the media, the internet, cell phones, things like this weren't easily proven. You had to be on the ground in order to know what was going on, or take the word of somebody else. Now, I've chosen to look at three different types of white-collar crimes, the first being embezzlement. Embezzlement is described as fraudulent taking of personal property by someone whom it was entrusted, most often associated with misappropriation of money. Embezzlement can occur regardless of whether the defendant keeps the personal property or transfers it to a third party. Embezzlement can be perpetrated by anyone with access to a company or organization's finances. Small, unnoticeable amounts over long periods of time, or large one-time sums that are taken from accounts are typically how embezzlement is perpetrated. A fun fact is, the IRS requires embezzled funds to be reported on your gross income. Failure to do so can entail tax evasion charges and penalties once you are caught. Second is securities fraud, also known as stock fraud and investment fraud, is a deceptive practice in the stock or commodities market that induces investors to make purchase or sale decisions based on false information, frequently resulting in losses in violation of security laws. Executives at publicly traded firms are often inclined to commit securities fraud because much of their personal holdings may be in the form of stock in their company. This may include, but is not limited to, hiding debts, inflating earnings, causing higher valuation of the company. Executives may begin to dump their stocks when they feel like it's all about to catch up with them. If they know they're about to be caught and the company is going to go bankrupt, they're going to want to sell their stock at a higher price in order to retain all of their assets. Next is a Ponzi scheme. A Ponzi scheme is an investment fraud that involves the payment of purported returns to existing investors from funds contributed by new investors. Ponzi scheme organizers often solicit new investors by promising to invest funds in opportunities claimed to generate high returns with little to no risk. In simple terms, a Ponzi scheme is where an investor puts money into a company, that the person who runs the company takes that money, pays their older investors with the new cash, and so on and so forth, and the cycle continues with no money ever actually being invested. All of their earnings and all of the profits that they say they're making are simply falsified. Collapse can occur when either there are no new investors or if too many of the investors withdraw their funds at the same time. Now, I chose to highlight Bernie Madoff because he's known to have run one of the largest Ponzi schemes in the history of the United States and in the history of the world. Over the life of his investment firm, which was an intricate Ponzi scheme, he cheated investors out of roughly $65 billion on paper and made off with approximately $22 billion. He was one of the founders of NASDAQ and was an advisor to the SEC on securities trading, so although he was suspected a time or two of having some shady deals, who could doubt him? He was an advisor to the agency of the United States that investigates these types of fraud. His scheme began to collapse when investors requested $7 billion in returns, with only $200 to $300 million in available cash. Madoff told his sons of his scheme, and they immediately reported him to the SEC. Now, again, I will illustrate a fact that this is not a victimless crime. 3 people involved with the Ponzi scheme, including Bernie Madoff's own son, committed suicide in the days after the revolutions of his actions. A second case I want to illustrate is Enron. One of the most famous cases of white-collar crime and fraud on a massive scale is the Enron scandal. Enron, with the help of Arthur Andersen, which was their accounting firm, and in an intricate set of schemes, hid billions of dollars of debt in shell corporations. As the CEO dumped his stock in the days leading up to the collapse, he still encouraged employees to buy, thus driving up the price of his stock. Along with the CEO, other executives, through deregulation, were allowed to oversee the financial statement preparations that were released to investors along with employees. They took compensation and bonuses based on the false earnings that they inflated, which subsequently caused the company to go bankrupt. Investors lost upwards of $70 billion, and employees lost close to $2 billion. Their accounting firm, Arthur Andersen, was complicit and aided in the scandal at Enron. Many of these companies could not perpetrate their actions without having help from their accounting firms and their auditors, which is why it is important to demand ethical behavior from our accounting firms and our finance reporting companies. The effects on investors. Now, many investors in the United States sometimes don't have a lot of trust in Wall Street and these big businesses that they're investing in. As I have said before, some feel as though white-collar crimes are victimless, but those who have been victimized by white-collar crimes will disagree. For the Bernie Madoff investors, many of them lost their entire life savings, pension funds, and retirement accounts. Losses totaled $65 billion. Enron investors and employees lost close to $72 billion. Again, many of whom lost all of their retirements, their children's college accounts, their homes, their vehicles, their insurance. As more scandals surface, particularly in the last decade and a half, it gives the appearance that these criminals can live out in the open and live extraordinary lives, all while ruining the lives of others. Once caught, many of these men and women, not all, but some, receive light jail time and instead spend their time on probation or on house arrest in their million-dollar mansions. Ethics, business, and white-collar criminals. They all are intertwined. In our society, unethical behavior has almost been an accepted practice, assuming that if a company reaches a certain size, they're going to have to cut some corners in order to get to that size. And once they are that big, they're too big to fail. Or so that's what they told us during the financial crisis from late 2007 into 2009. Repetition of these financial deceit and unethical acts, decade after decade, whether that be Enron, Bernie Madoff, AIG, or the Lehman Brothers, further reinforces the lack of trust that we have with our big financial institutions. Maurice Green, an AIG executive, which was one of the companies which almost went bankrupt during the financial crisis of 2007 to 2009, brought a suit against the United States government in 2012 for buying up 79.9% of its shares and taking control of the company. He felt as though he had been cheated out of millions of dollars and lost control of the company unfairly. Now, this just shows the lack of respect that these executives have for the American people and their tax dollars. Our government went in, bailed out AIG, saved the company, and allowed them to continue to do business, all while fighting off lawsuits brought against by their executives. This shows that they have no respect and no appreciation for what the taxpayer did, keeping them from failing. Again, they believe they're too big to fail, and without them, our entire economic system would collapse. Now, there is government control and regulation, but some may argue there's not enough. Back in 1890, the Sherman Antitrust Act was the first major legislation passed. This legislation allowed the U.S. government to prohibit any companies from creating monopolies and conspiracy and restraint of interstate and foreign trade. The Clayton Act was passed in 1914, which gave the federal government more power to enforce the Sherman Antitrust Act. This allowed them to crack down on monopolies and other illegal and deceitful acts perpetrated by these large companies. In the last 15 to 20 years, there has been more government regulation passed, such as the Sarbanes-Oxley Act of 2002, which was passed in order to improve financial disclosure from large companies after incidents such as the Enron scandal and WorldCom. Now, the continuation of government control and regulation, or some believe there may be a lack thereof, shows that our country is not where it needs to be. While there was sweeping change brought on by SOX, the financial crisis of 2008 was a clear indicator that there was not enough regulation put on the finance industry. There's no punishment for the abuse of investor funds, taking taxpayer bailouts, and ineffective legislation post-2009 has allowed companies to continue to do the things that have gotten us in trouble so many times before. The Dodd-Frank Wall Street Reform and Consumer Protection Act was passed in 2010. Now, this was supposed to be the sweeping change that the whole country had been craving, but all this did was have light punishment for Wall Street, create a further complex set of laws and regulation which would allow companies to continue to deceive the taxpayer and the investors for years and years to come. I hope you've enjoyed this presentation. Thank you for watching. Have a good afternoon. Attached is my list of references.